foreign exchange currency, no matter which one you look at, across the board, spot silver is at record highs, unlike protected or capped US-centric futures silver. It's so obvious. It's mind-boggling and yet we look at them, listen to Main Street, I'm on Bloomberg all the time. While they are caught onto gold, they have no idea that the silver market's broken and how undervalued dollar silver is. And that reflects what it is doing is reflecting really the supply shortages, with this effect forcing the US silver prices much, much, much higher.
In a Monday note, Goldman Sachs analysts said silver prices would likely rise in the medium term as potential Fed rate cuts draw more private investors into gold, lifting silver in turn. The traditional model of unified global silver pricing shows signs of fundamental breakdown. Regional markets increasingly set prices based on local supply-demand characteristics rather than following London and COMEX benchmarks. London spot premiums have reportedly reached $3 per ounce above New York futures, while Shanghai prices maintain approximately $8 premiums over COMEX contracts. These disparities exceed normal transportation and insurance costs, indicating geographic market fragmentation. AndrewMaguire warns that the global silver market is under severe strain. He notes that 160 COMEX contracts should have reached London days ago, but delays expose deep logistical stress. Maguire says U.S. silver shipments are merely postponing an imminent default in the system. Spot silver has hit record highs in nearly every major currency, except the U.S. dollar. This makes the American silver market the obvious global outlier and the center of pressure. The physical metal is instantly absorbed by the market upon arrival, proving the shortages are chronic. Maguire adds that the situation has become so extreme that some refiners and suppliers refuse to part with metal unless prices rise substantially. According to AndrewMaguire, China's silver export limits and fierce global bidding have further strangled supply. He reveals that major bullion banks like JP Morgan and UBS are struggling to cover massive unallocated silver exposures as default risks rise. Maguire points to a quiet U.S. regulatory shift, reducing scrutiny of bank metal derivatives, a move he says signals panic and shields the most vulnerable institutions. Before we dive into AndrewMaguire's sharp insights from their latest interview, make sure to hit that subscribe button and tap the bell icon so you never miss a moment when truth meets the market. Let's get into it.
Silver actually should have immediately been flown out last week, last Thursday, last Friday. 160 SI lots would equal 25 tons. You could put those in on a plane for a matter of a few extra cents per ounce. Yet it was very slow to move. And this is really what we're drawing attention to. And while we're evidencing some profiting from shipping US bars to London, and we'll look at why this will not lower the higher spot price to meet the lower futures price. In fact, the opposite is going to happen. So minor short-term volatility aside, it's the record high global spot prices in every single other foreign exchange currency, no matter which one you look at, across the board, spot silver is at record highs, unlike protected or capped US-centric futures silver. It's so obvious. It's mind-boggling and yet we look at them, listen to Main Street, I'm on Bloomberg all the time. While they are caught onto gold, they have no idea that the silver market's broken and how undervalued dollar silver is. And that reflects what it is doing is reflecting really the supply shortages, with this effect forcing the US silver prices much, much, much higher. The US is the sole outlier and is being targeted. And while the LBMA clearing members are facing default and are really racing to fly out what little silver bullion they can from the COMEX registered and eligible stocks into London, this is largely serving to satisfy immediate, unallocated, over-the-counter bets that have been called for delivery into empty local London vaults. It's just really trying to keep pace with an immediate default. Notably, illustrating it takes higher prices to bring silver to market. So it's evident. This basis EFP spread and lease costs, they expand significantly into lower prices. They contract into higher prices, but literally expand significantly into lower prices. Nobody wants to lease this out. And while inbound US silver shipments are serving to relieve some of the EFP basis spreads between the COMEX futures and spot, currently still averaging a deeply backwardated, I'm looking at it right now, deeply averaging a dollar spread. I mean, that's still $5,000. And we've seen it's about 77 cents into the highs, but today at $1.60 into the lows. So this is plenty of time to have shipped out silver to meet this demand. It's not hard to put 25 tons on a cargo flight. Now, so global physical shortages is really what they're going to do is really quickly absorb anything that arrives in London. In fact, while shipments are serving to avoid an immediate default, the only solution actually is to bring more bullion to market. It would have to be at higher prices because otherwise it's not going to be offered. Now, the PBOC implemented silver export controls, and they're in effect in mainland China. And while these same 4 LPMCL clearing members are able to access offshore CNH future silver from the western-facing Shanghai Gold Exchange international hubs, the bullion is also being competitively bid to fulfill other global shortages, further tightening supply. Everyone wants silver. So while these inadequate LPMCL US and China shipments may have brought some temporary default relief, the net solution to avoid default is for these silver cartel members to buy back large, unallocated silver exposure with physical at higher market prices. What we're witnessing is an at all cost protection of the officially held COMEX LBMA OCC bets against silver futures breaching very large short stops that have only just begun to be tripped off above the May the 1st, 2011 50 highs, which was here. And notice that the pullbacks have come back to this level. Now, these stops, the further up you get here, these stops will ignite, can really risk igniting, and ultimately will spiral into an out of control disconnect versus the globally determined spot silver benchmarks. Very short term, we assessed in our last episode and in the prior ones, while we expect 53 to be the next rally staging post, liquidity providers assess $140 silver would provide the most likely staging point to bring sufficient bullion to market, and it will require sufficient bullion to come to market for the short covering to be completed. Now, we were looking at futures, but in the spot market, the real spot market, which is basically driven by every single other currency, FX currency in silver, making all-time fresh highs, we have indeed seen silver testing the 53s, the mid-53s. And it's really this EFP spread, which we're sort of looking at and going to explain better, that is causing this disconnect. Here's a quick example of silver in offshore in the SGEI exchange, the offshore Chinese exchange. And while I'm looking at also gold. So as is evidenced by the unprecedented full spectrum backwardation into as deep as July 2028, mind-boggling. You have to look at it to believe it. And it's improved somewhat, but this is a broken market. And as we assessed last time, even into the 1979 to 1980 Hunt Brothers short squeeze, these sort of backwardations did not exist. And whereas the Hunt Brothers backwardation were able to be contained and cash settled inside the siloed COMEX, where essentially that's where the market was, now the price-taking physical liquidity has been captured by the Western-facing SGEI physical exchanges, influencing every other silver and gold foreign exchange cross. And as we previously ascertained, the quarterly OCC reports, the Office of the Comptroller reports, lists the historically accrued, unallocated, unbacked foreign exchange silver derivative bets being stick-handled for the Fed by the two remaining Fed agent banks, JP Morgan and Citi. Now, do you remember we showed the third quarter unwind of the 5-year derivative bets? That was an important point to note. But actually, out of the 4 LPMCL members, that's ICBC, Standard Bank, JP Morgan, UBS, and obviously, so basically, it's only JP Morgan that provides the only LPMCL cartel member that provides the conduit into the OCC derivative bet.
Regarding the fourth quarter metals rally, AndrewMaguire explains that both gold and silver are rising on real physical demand, despite repeated suppression attempts. Margin hikes and synthetic selling by the CME and LBMA cartel have failed, exposing deep cracks in the paper market. With major banks trapped in unallocated short positions, COMEX now faces mounting pressure amid tightening global supply. As physical tightness worsens, traders and short sellers who depend on borrowed metal are finding themselves in a serious bind. Those who sold futures contracts are now scrambling to find silver to meet delivery obligations. Something much bigger is happening beneath the surface. What's really changing is how silver's price is being set. For decades, silver's spot price was largely controlled by futures trading on COMEX, a paper-based system dominated by speculative short sellers and algorithmic funds. That structure allowed paper silver positions to steer price action, often suppressing rallies even when physical demand was strong. Let's get back to the interview.
Let's take a quick look at the charts. To quickly recap, gold began trading on the fourth quarter trading at our end of third quarter 38.50 staging point here, and silver ended up consolidating at its 46.50 staging point. And obviously, we're looking to follow these footprints. Now, this represents the first 2 weeks of the fourth quarter in October in silver, and the same in gold. And following these 2 solid weeks of gains in both gold and silver, there's been several expected attempts to rein the rallies in both gold and silver, which have really wrong-footed the unallocated London cartel. Now, this was particularly evident, actually, in silver. In fact, the bulk of our questions revolve around silver, and we'll spend a good deal of time answering them shortly. However, spoiler alert, every attempt to synthetically cap prices, and this is why we're looking at the futures charts right now, each of these attempts have been completely siloed inside the cash-settled CME exchanges and really has been limited to target the naked long speculators who coattail each fresh leg of very real, physically driven rallies. Exactly the same situation in gold, and each time that there has been an attempt, it has been shallow. And as we assessed in our last episode, each of these sell attempts exposed the LBMA CME COMEX as broken price takers. And with very few remaining real money traders still trusting the COMEX, it severely limited the ability to generate sufficient downside sell ignition that really could cause any lasting damage to what is a physically driven rally. Now, while we see the same in gold, silver always provides a better view of the footprints. Now, the first real attempt for this month occurred into what was actually a coordinated margin borrowing cost. Margins just means borrowing cost to borrow COMEX positions, whether it's silver or gold. And there was an announcement, which by no coincidence was timed with Powell's speech. And that was on the 9th, with saying that the cost to borrow these positions for COMEX, gold and silver would rise the next day on the 10th. Now, whereas as we demonstrated in our last episode, the reason for the House delaying raising margins was to protect very large wrong-footed naked short commercials bets being called for delivery in China, but also that was to meet a large influx of Western ETF demand. We saw exactly the same thing in gold, which better represents the ETF demand. However, trapped between calls for bullion that they didn't have, and that by the 9th of October, just enough naked longs had got on board, speculators who had borrowed gold and silver from the house had got on board, it was deemed to be an optimum point to spring higher borrowing costs on this extremely leveraged group of naked long traders. And we're recording this on Wednesday, the 15th. So following this attempt, following another attempt yesterday on Tuesday, following another attempt today, essentially these rigged pit manager bid pulled events, and that's what it is. They're bid pulling. They know where the stops are, but there's very, very few speculators. There's very little real money involved, and it's really down to how many speculators can they rinse out on the way up. So these bid pull events are both necessary and constructive, serving to rinse out the low-hanging spec froth, which has really coattailed the latest bout of upside momentum in silver and in gold. So to explain what's going on here are the two illustrations we showed when gold was still under 4,000 and silver was still under 48. Now, as you can see, we were questioning why was it that the $17,000 carry cost to borrow a single 100-ounce COMEX gold contract, which was worth at the time $280,000, why had it not risen when gold was trading at $390,000? And then also the $16,000 cost to carry a 5,000-ounce silver contract, and that was at the time valued at $165,000. Well, why hadn't it risen when silver was trading $237,000? And they, of course, have risen since. Now, the reason was because the CME LBMA Cartel Alliance, which is, as we've talked about multiple times over the year, the London Precious Metals Clearing, LPM and LPMCL, which are the four clearing banks that we've gone over year after year, that we've tracked since their formation, actually, since April 2001. These guys, this cartel was on the wrong side of very, very large unallocated short positions. When we say unallocated, they're not one-to-one backed. And these positions were actually being used to report as hedging an equal number of, get this, asymmetric, imbalanced COMEX gold and silver positions. So you've got an unbacked futures foreign exchange position balancing or supposedly hedging a totally imbalanced COMEX gold and silver position. So these are the banks that were basically settling stuff on their own books and then really just having to buy physical when it was absolutely necessary. Now, following a large forced short covering move, now, if you recall, the Bank of International Settlements having to square shorts at the end of the third quarter, the Fed having to square those BIS borrowings at the end of the third quarter. If you remember, we looked at it. They had to cover them $409 an ounce higher than they had sold it for in the attempts to cap gold, and they were wrong-footed. And that did expose the next 30 tons that they are still outstanding. Well, at that point was going to cost them $4 billion in losses. That's a heck of a lot more now that gold has risen significantly since we illustrated this. Now, the CME finally raised their gold and silver margins, respectively, from 17,000 to 18,000, and in silver from 16 to 17,500. However, the good thing is, other than a dwindling number of speculators, there are very few real money takers. So while the LPMCL cartel has the ability to cash settle unallocated gold and silver by way of literally laying these bets amongst the wider scope of all LBMA member banks, whoever is a taker, very little physical bullion is shuffled into this mix.
Silver occupies a unique position among precious metals due to its extensive industrial applications combined with investment and monetary demand. History has a way of repeating itself, especially in the silver market. When silver goes into deep backwardation, it almost always marks a major bullish turning point. The last time backwardation exceeded $2 was in January 1980, and what followed was nothing short of explosive. Are we now seeing the beginning of a true silver revaluation led by the physical market finally asserting its real value? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the following video.